Welcome to the deep dive. Today we're really challenging the notion of safety when it comes to bonds. They often feel like, the quiet, reliable cousin in your portfolio.
Yeah, maybe a bit boring sometimes.
Exactly. But our mission today is to uncover why they're actually anything but boring.
Definitely. We're going beyond just the surface, trying to reveal their true dynamics and their really crucial role in managing risk and seeking return. We'll be drawing on some pretty foundational texts in finance here.
Okay, so let's start there. A bond, at its core, it offers a fixed interest payment, right? And you get your money back at maturity.
Yeah,
Seems straightforward.
it does seem straightforward. But what's truly fascinating is how outside factors, external factors, profoundly impact that supposedly fixed payment.
How so?
Well, take inflation, for instance. Inflation can sharply diminish the real value, the purchasing power, of a bond's interest.
Ah, right.
So when investors expect prices to go up fast, they'll naturally demand higher rates to compensate for that expected loss of value.
Okay, so a bond that seems safe on paper could actually lose you money in real terms if inflation heats up.
Precisely.
This really challenges the whole idea of safety. I mean, the intelligent investor even suggests there can be less real risk in buying let's say, a bargain issue, stock one, trading way below its value, than a conventional bond yielding maybe 4.5%.
It's a bit of a mind bender, isn't it?
It really is. It flips the script.
And it brings up a really important question. What exactly is risk? Is it just prices bouncing around?
Well, many define it that way by volatility.
Right. But the intelligent investor cautions that just looking at volatility can be harmful for making sound decisions. It might lead you to sell low or chase things that are jumping around.
Instead of looking at the underlying value.
Exactly. The key is understanding how different bonds respond to things like interest rate changes. Long-term bonds, for example, they can get hit really hard when rates rise, whereas shorter-term stuff, like Treasury bills, barely affected. In T-bills, well, Treasury securities generally, they have huge market size, and the interest is often state tax-free too, which is a plus.
So given these maybe surprising truths about bond risk as returns, where do they actually fit in your portfolio? We always hear about balancing stocks and bonds. But with this understanding, what does that balance really look like?
Well, connecting this to the bigger picture, bonds are traditionally seen as, risk moderators.
Right.
Think back to the 07-09 crash.
Oh, yeah. Rough time for stocks.
Very rough. But bonds actually provided a positive return then. They successfully moderated that overall portfolio risk. Kind of reaffirms that principle of maybe shifting more towards bonds as you get older, reducing the stock portion.
Okay, that makes sense. But are all bonds created equal in playing that role?
Ah, good question. And the answer is definitely no. Common sense on mutual funds points out that bond funds, as a group, have often failed to return what the actual bond market itself did.
Really? Why is that?
Often costs, but also maybe chasing yield. The book explicitly warns against buying a bond or, say, a preferred stock just because it has an attractive yield if it lacks adequate safety. That yield might be misleading.
So chasing high yields can backfire if the underlying bond isn't solid.
Absolutely. And speaking of costs, the data consistently shows how critical cost is in bond investing. It's huge.
How huge!
Well, one analysis looked at long-term unibond funds. A 1% drop in costs led to a 1.3 percentage point increase in return for the investor.
Wow, that's more than 1-for-1.
It is, and a hypothetical bond index fund in that study, consistently near the top for returns and at the bottom for cost.
That's pretty stark. So for you, the investor, it really boils down to how much of your return you're okay with just giving away in fees, even for something seen as a commodity like bonds.
That's a good way to put it. Low-cost bond index funds in one study, they only consumed about 6% in expenses. That left 94% of the return for the investors.
And the traditional funds?
They ate up 14%. And get this, in 2008, the broad bond market index was actually up 5%. But 633 out of about 1,000 taxable bond funds actually declined that year. Some lost, believe it or not, as much as 79%.
79% loss. In a year, the bond market was up. How is that even possible?
High costs, bad strategies, maybe leverage, chasing risky stuff. It highlights this persistent issue. Low-cost bond fund options are still surprisingly hard to find.
Really? Even now?
Yeah, only about 1 in 20 bond funds has an expense ratio under 0.5%, 0.5%. Yet for these kinds of commodity market segments, index funds can be run for like 20 basis points, it's 0.2% or even less.
So wrapping this up, bonds are clearly far from boring. They're a dynamic part of the investment world, Crucial for diversification, managing risk.
And maybe even finding value, if you
Right.
look carefully.
Right.
Exactly. The idea is to approach bonds not just as some safe default option, but, with intelligent effort, recognizing their complex role in balancing risk and return.
Which means understanding inflation, interest
Mhm.
rates.
Their real impact. And critically, how much those costs can eat away at your returns over the long haul.
So what stands out to you listening? Think about how understanding these nuances, these sort of hidden dynamics, changes your perspective on what we just call safe money.
Yeah, do bonds still seem quite so boring now?
Maybe the real excitement in investing isn't always in the high-flying stocks, but in uncovering these deeper, sometimes counterintuitive truths about all parts of your portfolio.